Hello everyone and welcome back to our channel. Today, we have an essential topic that can greatly impact your financial success. How to improve your credit score. Your credit score plays a crucial role in many aspects of your financial life, from getting loans and credit cards to securing better interest rates. So, in this video, we'll be sharing 7 effective tips to help you boost your credit score and set yourself up for financial success. Let's dive right in. Number 1. Don't close old accounts. Closing old credit accounts might seem like a good idea, but it can harm your credit score. Additionally, older accounts showcase your experience in managing credit over an extended period. The longer your credit history, the more accurately lenders can assess your creditworthiness. Closing old accounts can shorten your credit history, potentially raising concerns for lenders as they have less data to evaluate your financial behavior. However, if you find yourself with numerous credit cards and are tempted to close some, focus on the ones with higher interest rates or annual fees, while keeping your oldest ones active. Keeping a diverse range of credit accounts open and in good standing reflects positively on your credit profile, ultimately boosting your credit score. Remember, responsible financial behavior over time builds a solid credit foundation. So, embrace the longevity of your old accounts and let them contribute to your path to financial success. Number 2. Limit new credit applications. It's important to understand the impact of new credit applications on your credit score. When you apply for a new credit card, loan, or any other form of credit, the lender pulls your credit report to assess your creditworthiness. This action creates a hard inquiry, which remains on your credit report for up to 2 years. Multiple hard inquiries within a short period can signal to lenders that you might be experiencing financial difficulties or are taking on too much debt. As a result, your credit score may see a slight dip. To mitigate this effect, be strategic about applying for new credit. Only do so when it's necessary, and when you're confident in your ability to be approved. If you're planning to make a major purchase, such as a home or car, spacing out credit applications and consolidating them within a short time frame can minimize the impact on your credit score. Being mindful of when and why you apply for new credit shows responsible financial planning, which ultimately supports your journey towards a higher credit score and overall financial success. Number 3. Become an authorized user. Becoming an authorized user on someone else's credit card can be a strategic move to improve your credit score, especially if you're just starting to build credit or looking to recover from past financial challenges. When you become an authorized user, the account's history is added to your credit report. If the primary account holder has a long-established credit history with on-time payments and low credit utilization, it can have a positive impact on your own credit score. However, it's crucial to communicate openly with the primary account holder and ensure they understand the responsibility that comes with this arrangement. On the flip side, be cautious about becoming an authorized user on a credit card with a negative payment history, as this could adversely affect your credit score. Remember, while being an authorized user can provide a helpful boost, it should complement your efforts to build your credit independently. Aim to establish your credit history with your own accounts and demonstrate responsible credit habits. As with any credit-building strategy, patience and consistency are key. Keep a close eye on your credit report to monitor your progress, and over time, you'll witness the positive impact of this collaborative approach on your journey to financial success. Number 4. Diversify your credit mix. Maintaining a diverse credit mix demonstrates to lenders that you can handle various types of credit responsibly. It shows that you are not reliant on just one form of credit and can effectively manage different financial obligations. A diverse credit mix typically includes credit cards, which are revolving credit accounts that allow you to borrow up to a certain limit and repay the balance monthly. Installment loans, on the other hand, involve borrowing a specific amount and making fixed monthly payments until the loan is fully repaid, like car loans or student loans. Lastly, retail accounts are credit lines offered by specific stores to finance purchases. When you responsibly manage different types of credit, it showcases your ability to handle varying financial responsibilities. However, it's essential to exercise caution and only take on credit that you genuinely need and can comfortably manage. Remember, while a diverse credit mix is beneficial, it's just one piece of the credit score puzzle. Other factors, such as payment history and credit utilization, hold more significant weight. So, focus on maintaining a diverse credit portfolio while consistently practicing good credit habits to see a positive impact on your credit score and overall financial success. Number 5. Settle past due accounts. Addressing past due accounts is crucial for improving your credit score and financial standing. Delinquent accounts, whether from missed payments or defaulted loans, can significantly impact your credit score and stay on your credit report for up to 7 years. Tip number 5 emphasizes the importance of taking proactive steps to settle these accounts. Reach out to your creditors to discuss payment options, and if needed, negotiate a payment plan that aligns with your financial situation. Many creditors are willing to work with you to find a solution and help you get back on track. In some cases, you may have the opportunity to request a pay-for-delete agreement with the creditor. This means you negotiate to pay the outstanding debt in exchange for the creditor removing the negative entry from your credit report. While not all creditors may agree to this, it can be a powerful way to improve your credit score. Remember, being responsible in addressing past due accounts not only positively impacts your credit score, but also demonstrates to lenders that you are committed to honoring your financial obligations. With persistence and good communication, you can pave the way to financial recovery and success. Number 6. Regularly monitor your credit. Regularly monitoring your credit is an essential habit for anyone looking to maintain healthy financial well-being. Your credit score is a dynamic number that can fluctuate based on various factors, such as payment history, credit utilization, and new credit applications. Tip number 6 emphasizes the significance of staying vigilant and informed about your credit standing. By checking your credit score and credit report regularly, you can promptly identify any inaccuracies or signs of potential identity theft. Detecting errors early allows you to take corrective action before they harm your creditworthiness. Moreover, monitoring your credit provides insights into your financial habits and patterns. Observing positive changes, such as a reduced credit card balance or a record of on-time payments, reinforces the importance of responsible financial behavior. Various online platforms and credit card issuers offer free credit score tracking, making it easier than ever to keep tabs on your credit health. Take advantage of these resources to track your progress towards your credit goals and set yourself up for financial success. Number 7. Reduce credit card balances. Reducing credit card balances is a fundamental step towards improving your credit score and overall financial health. Credit card utilization, which is the ratio of your credit card balances to your credit limits, is a critical factor that influences your credit score. Tip number 7 highlights the importance of keeping your credit card balances below 30% of your credit limit. Maintaining a low credit utilization ratio shows lenders that you are responsible with your credit and not overly reliant on borrowed funds. High credit card balances, on the other hand, can raise concerns about your ability to manage debt effectively. By actively working to lower your credit card balances, you demonstrate disciplined financial management and a commitment to reducing debt. Consider creating a budget and setting aside a portion of your income to pay down outstanding credit card balances systematically. In addition to improving your credit score, reducing credit card balances can also lead to lower interest charges, which can save you money in the long run. Remember, the goal is not to eliminate credit card usage entirely, but to use credit responsibly and pay off balances regularly. Strive to strike a balance between managing your credit utilization and maintaining financial flexibility for unforeseen expenses. As you consistently work towards reducing credit card balances, you'll witness your credit score gradually improve, paving the way for better financial opportunities and achieving your long-term financial goals. That brings us to the end of our video on how to improve your credit score. 7 tips for financial success. Remember, your credit score is a powerful tool that can open doors to better financial opportunities. By following these tips and staying committed, you can pave the way for a brighter financial future. If you found this video helpful, don't forget to give it a thumbs up, share it with your friends, and subscribe to our channel for more valuable content. As always, thank you for watching, and we'll see you in the next video. Take care and happy financial success.